Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Bloomberg News learns that the Trump team is looking at a slow and steady approach to tariff hikes rather than going all out on day one. This, they think, will help avoid a spike in inflation. And as the clock ticks towards a TikTok ban in America, Chinese officials are said to be looking at Elon Musk as a potential buyer of the app's U.S. operations. Also ahead, investors surveyed by Bloomberg see India's $550 billion equity market rout worsening as the economy cools, but the rupee's plunge to a record low may help its software firms. And for a view on that and the business outlook, we speak live with the CEO of HCLTECH, India's third largest IT services company. We'll also ask him about the raging debate in the US over H-1B visas. Starting with our Bloomberg scoop, Chinese officials are discussing the sale of TikTok's U.S. operations to Elon Musk. That's if the company fails to fend off a controversial ban on the short video app. Let's bring in our tech reporter, Annabelle Drillers, for more. Belle, put this in perspective for us.
Well, this is certainly a very interesting development, and it is a Bloomberg scoop, as you said, so we're hearing this according to our sources this morning. But the headline here is that Beijing is essentially looking at what are the options, because at this point in time, and especially after the US hearings in the Supreme Court on Friday, it does seem that after January 19, TikTok in the US is going to be going dark. So that means that users won't be able to access the app for download, and they're also not going to be receiving any updates for the app. So what we're hearing from Beijing officials is that the preference, or one of the preferences following, of course, the primary one being ByteDance continuing to retain control, but sort of a plan B or a plan C, could be Elon Musk acquiring the platform. Now, what's in it for Musk? This is something that would be acquired by X, so those two companies will continue to work alongside each other, but certainly X could benefit from more advertiser revenue, for instance, from TikTok, and then also there's XAI, which is the artificial intelligence company that Musk founded, that could also benefit from the huge amounts of data that's being generated. In terms of the value of this, how much this could actually be worth, Bloomberg Intelligence last year was saying somewhere $40 to $50 billion. How Musk would finance this? I mean, he's still continuing to pay off those loans for X, even though being the richest man in the world, $40 to $50 billion, it's not cheap, of course. So lots of unknowns at this point in time. But again, going back to the primary one is that Beijing officials, after preferring TikTok to remain under ByteDance ownership, they are considering other options. And one of those could be Elon Musk acquiring the TikTok app in the US.
At this point in time, Belle, we don't even know if ByteDance, the parent company, is part of conversations. This is one option. What are the other options out there? As you said, $40–50 billion value is not chump change for Musk.
Yeah, so, I mean, in terms of the other options, we definitely know at this stage that the preference and what ByteDance has already been signalling is that they're going to continue to fight that. So that's sort of the primary one. But just talking about the terms of the deal and what we know about it so far, it's actually not exactly even clear how much ByteDance is being involved in these discussions with Beijing officials on this very topic, or whether ByteDance, TikTok and Musk or X have as well held conversations about this possibility. So there's really still a lot that we don't know at this point in time. It's just one of the possibilities that's being floated, but it does really underscore something else that's very clear. I mean, we know that Beijing has the ability to block this sale, but just digging into the details of that, how they can actually block it. Well, firstly, the Chinese government does hold a so-called golden share in the ByteDance affiliate Douyin. That's sort of the TikTok equivalent in China. ByteDance would say that golden share only applies to Douyin. The Chinese government might say elsewhere or otherwise, but certainly there are export rules in place that prevent Chinese companies from selling their software algorithms, and that is really what's very much priced here, or one of the aspects that's very much priced is TikTok's algorithm. So they're certainly going to be taking a large interest, and they are taking a large interest in where this goes next, amongst a host of other factors that both the Chinese and the US governments need to consider from next week with Donald Trump back in the White House. But just quickly to note as well, the migration that we're seeing, actually TikTok users are continuing to go to other channels, and two of those that are really grabbing the attention this morning, Xiaohongshu, which is Red Note, and then there's also Lemonade, which is owned by ByteDance. But Xiaohongshu and Lemonade, they're both Chinese apps. So even if we see TikTok banned in the US, it doesn't necessarily mean that that's going to be benefiting US social media giants either.
Interesting how this is playing out. Our tech reporter Annabelle Drillers in Hong Kong. Now, in other news, members of President-elect Donald Trump's incoming economic team are said to be discussing slowly ramping up tariffs month by month. Sources say the gradual approach is aimed at boosting negotiating strength while helping avoid a spike in inflation. We're told the proposal is in its early stages and has not been presented to Trump. Well, speaking of China, let's take a look at how China indexes are doing at this point in time in positive territory. In fact, the CSI 300 index up almost 2% as we speak. HCLTECH also trending up right now, up 2.5%. Avril Hong has more on the FX reaction to Trump tariffs today. It is about that dollar reaction, Avril.
Certainly. And I mean, you heard on the campaign trail, right? Trump talking about 10% universal tariffs, 60% or more on China. So just this idea that there will be a gradual approach. The hope is that it will mitigate the inflationary impact, give the Fed more room to reduce rates. So we saw a sharp move in the dollar at the open against almost every major currency after 5 sessions of gains. And this is I think, reflection of what might come under the Trump administration. You know, some of these knee-jerk reactions to market-moving information. Flip the board. Against this dollar fall, what we saw was reprieve for the Chinese currency, but also really interesting how that played out for the Kiwi dollar and the Aussie dollar. And our MLive colleague, Garfield Reynolds, makes the point that when it comes to Trump, you do get the sense that he might just be a factor complicating monetary policy for central banks halfway around the world. You know how the RBNZ, the RBA, they're seen by markets as substantially reducing their cash rates in the next 12 months or so. And we also have the likes of UBS saying that this gradual approach to tariffs might actually be problematic for the Fed.
So I think normally we think of tariffs as a one-off price level shift, and then it goes away a year later. And then provided it's not big enough, you don't have spillover effects. So you don't get second round effects that sort of are inflationary. But if you do rolling tariffs, it's a little bit like the repeat of the pandemic and the Ukraine shock that we had. You have one supply shock after the other, and you start to create sort of a much higher peak in inflation. So I think it would be much more difficult to sort of know what to do with that as a central bank.
So it might actually be more harmful than helpful for the inflationary picture. Haas?
Jury's still out. Avril Hong, thank you. Well, joining us for analysis now is Charu Chanana, Chief Investment Strategist at Saxo. So there's gradual approach, good or bad approach to adopt by the U.S.?
I would say a volatile approach. Good or bad would be, I think...
It is Trump administration, after all.
It is, and it is something that we need to brace for the next, this term that we are thrown into. I mean, we got a similar news a week or so back as well in the Washington Post as well, right? I do think that there is a sentiment from Trump's economic team where they do want to have that negotiating buffer. They do want to take it slow, but of course, when Trump is coming in, he's taking office next week, he wants to come across as a strong man, and he wants to be seen as the decision maker, not his team. And that's why we saw that Washington Post report being thrown into the bin, right away, just within a few hours. So we certainly need to wait and see what Trump's reaction is as well, because as you noted, right, this is not a plan that has been presented to Trump himself as of now. But I do think they do have these macro troubles as well, right? Inflation, bond yields, which they will need to take into account. The strong dollar is certainly something that, at least from a cyclical perspective, would potentially trouble stocks and would potentially trouble Trump also, So I think he would have to mend his approach accordingly, taking into account all of these factors as well.
We heard from Avril earlier on about how, the dollar is easing somewhat on the back of that news, but this remains a mighty dollar environment, and all we need is a statement, a comment from Trump to drive it higher.
Absolutely. I think right now, Trump, of course, is one factor, but even the macroeconomic data, U.S. exceptionalism continues to hold well. Bond yields are at fresh highs again, and there's plenty of, fundamental stories, as well as the volatility with Trump and the uncertainty that this new administration brings also kind of highlights once again the safe haven aspect of the dollar. So everything still points towards a stronger dollar, except for the point that the, positioning has become extremely long, and the valuation of the dollar is obviously a little bit expensive as well at this point. But of course, any announcements on the tariffs front, if they come out to be very aggressive, there's no reason why we couldn't see further strength in the US
We talk
dollar.
about the surging yield. Of course, we've seen how 10-year yields headed towards 5, inching ever closer. Some say it might not stop there. We could see 6. What's your assessment? What are the considerations when it comes to where yields are headed?
So 5% is a huge psychological barrier for sure, I would say. So I think that is
just a matter of when.
It is a matter of when. As of now, again, it seems like that, given the economic situation. But, let me go back a little bit. 2024, end of 2024, we did see the jobs market in the U.S. starting to loosen a little bit. Of course, now we've had, again, one very strong job data out last week. But I would say the economy is starting to be a little bit more mixed at this point compared to that level of strength that we had earlier in 2024. So if that kind of translates into, some higher levels of disappointment from the macroeconomic data, higher unemployment rate, I do think that there will be a situation where bond yields will start to be capped. Either the economy stays very, very strong. Well, that certainly supports the case that we could see some more higher yields. But if the economic momentum starts to weaken, and the Fed members start coming out to be a little bit more dovish, there will be potentially some pullback in the yields at this point.
But how are you reading the shift in yields? Is it a paradigm shift, something like a new normal, or is this temporary?
I would say, looking at the inflation picture, at Saxo, we've been saying that we don't expect inflation to come back down to 2% levels because there are structural shifts in the economy. And that obviously propels that yields are also going to be pinned a little bit higher than what we've been used to seeing. So there is a little bit of a structural aspect to it, I would say. But of course, what is right now driving the yields is all this volatility and the cyclicality of the economy, where the data is coming out strong, and then the Trump momentum also, if we were to get tariffs, that further kind of makes the U.S. exceptionalism linger for longer at the cost of the global economy. And that cyclically as well is boosting the yields as of now.
The thing is, the yields look really attractive. At what point will it take funds away from the stock market?
I think the fund flow is one of the biggest factors to consider. I think that is, in a tactical way, it is already happening. And that's what we see in the stock markets as well. There is a bit of a pullback there. I think the structural aspect of when high yields start to impact stock markets, borrowing costs are higher. But if the economy is doing well, the companies have that pricing power to pass on those higher costs as well to the consumers. So the stock market can still hold up. Or, of course, the economy weakens and we see a softer, tone from the Fed officials, and we see that support coming in through to the equity markets as well. But right now, that fund flow aspect is really the factor where, if you want yield, even the dividend stocks right now are paying less than what the bonds are paying. So there is certainly a shift happening towards the fixed income side.
All right, Charu, hang tight. Charu Chanana, Chief Investment Strategist at Saxo, is sticking around. Still to come, we're live at the Goldman Sachs Global Macro Conference in Hong Kong. Exclusive insights from the bank's Asia-Pac President, Kevin Sneader, later at this hour. Plus, we speak to HCL Technologies CEO C Vijayakumar as the tech giant and other Indian firms grapple with the rupee at record lows. Keep it here with us. This is Bloomberg.
Investors, maybe disappointed as growth slows down. But in my view, it's really an inevitable deceleration, which we're going through now. But if I look at the longer term outlook, something in the 6+ range, I think it's very realistic for India for many years. And that's a very rapid potential growth rate, even if it's not quite as rapid as the numbers we've been printing in the recent past.
Goldman Sachs chief economist Jan Hatzius is speaking to us at the bank's global macro conference in Hong Kong about India's growth outlook. Well, a Bloomberg survey has found that investors are expecting Indian stocks to post another quarter of losses. That's as a slowdown in economic growth and sticky inflation hurt corporate earnings and foreign flows. For more, let's bring in our Asia Actors reporter CJ Chakraborty in Mumbai. And CJ, most countries would be really happy with 6% growth, but when the world is expecting 6 is not good enough.
Yeah, I mean, you and I know better that markets is all about expectations, right? And delivering on those expectations or missing them. So clearly, at this point of time, investors seem a little unenthused by the fact that, India's growth trajectory, both for the economy as well as corporate earnings, is slowing down quite rapidly. If you look at, what has happened the past couple of quarters, and that is now reflecting in the stock market as well, with the index is down more than 10 to 12% since their highs back in late September, and it does look like the outlook for the first quarter as well is quite bleak, with a majority of the 22 odd respondents we had for our informal survey suggesting that they expect the market to fall in the start of the year.
CJ, just to put it in perspective, I mean, this is a stock market that tested new highs several times last year. I mean, a correction on the back of that, is pretty much expected. The question really is how much further will it fall?
Yeah, exactly. I mean, it's all about the perspective here, Haslinda. If you look at the market since the pandemic, it's more than trebled. It's probably at par with the US in terms of absolute returns. So a bit of a fraud taken off from the top may not worry a lot of them. But if you're a tactical investor, if you're fast money, then probably at this point of time, you're looking at the market and thinking maybe this is not the best place to be invested, given the concerns around earnings slowdown as well as the valuations, which have been a long-standing concern of foreign investors. And we can see it in their positioning as well, given that they still hold quite a lot of short positions in the index futures in India and are also, selling in the cash market at the same time. And that is sort of, weighing on sentiment at home as well, where we are seeing a little bit of concern whether, this market is going to remain sort of weak to, muted in the near term because of the concerns around valuations as well as earnings growth. The one point of view is that, of course, we have to wait and see for that earnings momentum to try and, turn towards positive. And maybe that will be the best time to, re-enter this market.
CJ, thank you so much for that. Our Asia Equities reporter, CJ Chakraborty in Mumbai. We're back with Charu Chanana, Chief Investment Strategist at Saxo. Charu, I mean, we're not even talking about valuations. They remain pretty elevated at about 20. So how attractive can that be when there's so much risk out there?
I mean, absolutely. There's, global uncertainty regarding, again, what we just talked about, Trump tariffs, and, how does China respond to it? I think that's something that we've not even been talking about yet. But once we get Trump to the office next week, I think it'll also be about that negotiation, whether that happens, how does China react, how weak can yuan go? And as a result of that, private capex in India has been sitting on the sidelines. You want to see what's happening on the global front before really allocating a huge amount of capital there. A lot of the growth that we've seen in India over the past few years has also been driven dramatically by government spending. So we need that consumer to step up. Of course, there's a wealthy consumer in India, but there's a huge wealth divide, and the middle income consumer has been squeezed as a result. So, of course, these are all factors that when you have some amount of uncertainty with those high levels of valuations, then, of course, you just need a perfect world to really justify those kind of valuations.
The thing is, that's a risk that is underappreciated right now. I mean, that could be China, disinflationary winds. Also, a lot of cheap Chinese goods flooding the Indian markets. That's a risk that people are not really factoring in when they look at the Indian market.
Again, a huge amount of uncertainty there. It could be potentially one of the key risks, but again, again, I'm sure India authorities have those countermeasures to kind of avoid that as well. They've done that in the past, and how things play out, where they get their wins and where they're not able to kind of go ahead with that negotiation will be the key factors to watch. And what that means is that the Indian stock market may not be as broad a story as it has been since the pandemic, and we have to probably get a little bit more selective there.
And also take a look at the rupee. Keeps testing new lows. It is hovering, at record lows right now. When the rupee is so weak, it's hard to buy into Indian stocks.
It's a huge factor for foreign investors, right? I mean, you're making money in the equities returns, but you're losing money in the currency exchange. And that's why we've seen a lot of foreign investors pull out of the Indian stock markets as well. And the problem is that the domestic participation in the Indian stock markets is not substantial. So that foreign outflow really affects the indices.
Is there a compelling reason to buy India if you take a longer term perspective? We have seen how people fell in love, how markets fell in love with India, and the surge came really quickly.
No, absolutely. I would say the structural forces are still very strong. You look at the demographic trend, you look at the urbanization trend, the amount of spending that is going behind infrastructure and climate change, things like that. It's a story that is really at the very, very beginning of that massive turnaround. And I think obviously the global forces play a part, but that will be really tactical stories. I would say this sell-off will, I think, again prove to be a very good entry point for those who have this structural long-term positive view on the Indian markets.
Elsewhere in Asia, all eyes are also on Japan and what the BOJ does. Of course, it is under pressure to move. It's been under pressure for some time and has yet to move. When do you see the next move coming?
I mean, there has been speculation once again that we could see something coming from the Bank of Japan in their meeting in the next week or so. And I mean, if you look at it from the reaction in the Japanese yen, I mean, we saw this massive gain in the dollar on Friday after the jobs report in the US. But, when you see this dollar surging higher, when you see the US yield surging higher, the impact you would expect would be the Japanese yen to weaken. But instead, we actually saw the Japanese yen proving quite strong against those headwinds as well. And that's, again, goes back to the point whether, there's some amount of anticipation that the BOJ will move ahead with its next rate hike in January. I think this is going to prove potentially to be a very, very volatile event, something, of the likes of what we saw back in July and August 2024, because this comes at a time when you do see the US earnings season and a little bit of a correction, I would say, in the Max 7 that have been driving the indices. You do see Trump taking office. And at the same time, if Bank of Japan was to come up with that rate hike, then that liquidity taps kind of, tightens further. And that is, I think, a huge volatility event that we should be really watching for in the next week or so.
Is there anything looking attractive in Japan?
I would say certainly, again, if you look at it from a structural point of view, this huge story around, shareholder returns, I think that's a huge positive. So dividend paying stocks are a huge story there. If you look at it from the perspective of, again, a dividing world, geopolitical tensions, and where do the AI chip factories go, I think Japan has really been at the forefront of giving subsidies to these chip manufacturers to come and set up shop in Japan. And, given their historic success with robotics and automation, I think that's a huge potential as well for Japanese stocks. But yeah, I think being selective would really be the key, if especially Japanese yen was to strengthen from here.
All right, Charu, thank you so much for your insights today. Thanks for joining us. Charu Chanana, Chief Investment Strategist at Saxo. And speaking of the yen and other Asian currencies, let's do a check on how they're performing at this point in time. We know that the dollar easing a little. We're seeing the yen at 157.68. In terms of the Chinese yuan, 734.41. Remember, the PBOC has been really active in keeping the currency stable, keeping it in a very tight range. And Korean won, 146.1 at this point in time. Well, up ahead, we'll take you to the Goldman Sachs Global Macro Conference, where APEC ex-Japan President Kevin Sneader talks about their business strategy for China and beyond. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside, and Chinese markets just headed to lunch. Quite a pretty positive day for China. We have the CSI 300 index inching higher, currently up by about 1.7%. Of course, traders mulling Trump's gradual approach to tariffs. Trump tariffs, by the way, have loomed large over all asset classes, especially in China today. That news driving stocks higher. CSI 300 index clearly in the positive. Of course, China securities regulator vowing efforts to stabilize market, yet another measure to provide support to the markets and try to, instill confidence among investors. So for the moment, the CSI 300 index in the positive, the US dollar versus the Chinese yuan at 734.37, the US dollar inching just slightly lower, providing some support for the Chinese currency. We're also tracking the Indian rupee as it starts trading. This is one currency that's been under a lot of pressure, hovering at record lows, and that's due to that growth story. We're seeing growth at 6% versus expectations of 8%, prompting investors to pull money out of the stock market. Of course, India's inflation sliding further. It is one factor that's been considered by traders. Now, let's head to the Goldman Sachs Global Macro Conference in Hong Kong, where our China correspondent Min Min Lo is there with our next guest. Min.
Hey, Has. Yes, joining me here is the perfect guest to tell us about the global macro environment. We have the Asia Pacific ex-Japan president of Goldman Sachs, Kevin Sneader. Kevin, so great to have you here. I should say thanks for having us. First of all, you've been here for half a day. Plenty of people here. I'm sure you've been interacting with them. What is top of mind for your clients? What's the most common questions you've been getting?
Well, Min Min, thank you very much indeed for joining us at this 16th edition of our Global Macro Conference. There's a lot that's top of mind, and the general heading, of course, is navigating 2025. And within that context, there's a lot of talk about President Trump and what that means for the global economy in terms of the US's approach to trade and other matters. There's an awful lot of discussion about the China-US relationship and how that might evolve. There's a lot of discussion about the China domestic economy and the status of the various reforms and stimulus and other actions that are being taken, some of which you've been reporting on this morning. And if you couple that with technology shifts and what that means, you've got a pretty broad agenda that people are trying to work their way through as they contemplate navigating the year ahead.
Yeah, and given the state of the Asian economy, because we have China's recovery sort of in question, India's economy as well, forecast for its growth this year being pared back, and then Korea somewhat in political turmoil. Given that sort of broad slowdown we're seeing, how is that affecting how you're deploying resources to this region?
Well, the reality is each of those economies has some unique factors that are colouring the way to look at them. If you take China, after September the 24th, there was quite a considerable rally that's not fully yet been dissipated, but that rally continues. And in that context, you've got to look hard about what can we expect to see or hope to see as we run up to the twin sessions, as we look ahead in the various stimulus and other activities that China may deploy. So it's not a dry understanding of China's going to just continue to slide. There's a real sense of how is this going to evolve and what do we therefore do. So for us, that means we continue to look and help our clients. I will say this, if you take things like M&A, equity capital markets activity, 75% of the large transactions that took place in the second half. So actually there's some momentum to be worked on and to work through as we look ahead. If you look, as you say, to India, yes, growth has come down. And I think it's true to say that India's had a bit of a speed bump. If you look at the earnings profile and if you look at the growth moving from, let's say, high 7s to low 6s. But we're still pretty convinced of the structural growth factors that will power India for the long term. So in that context, we continue to build our presence, increase our resourcing and maintain our focus on India as a growth opportunity. Korea, yes, there's political challenge in Korea at the moment. I'm actually headed to Korea on Thursday and Friday. I'll have a better sense of where things stand after that trip. But I will say this, it's interesting to note, there's still some very important technology-based companies in Korea, and we need to be there to continue to serve them. And so for us, we still remain long-term optimistic about Korea, but let's be clear, there are real near-term challenges.
Okay. Are you actually getting a lot of interest now from clients to reallocate back to China?
Well, we certainly have seen some reallocation back. But I would say this, there was a large move back in September, October, November, and that receded over time. People want to see the actions beyond the press conferences. There's been a number of press conferences, they continue, there has been talk, and there has been some action. But I think for the global investor to want to rotate back towards China, we need to see consistency and we need to see significance of activity and action. That's probably not going to occur until March, and so people are very focused on that window. At the moment, it's a bit of a wait and see. There's still a degree of caution.
If you're seeing momentum in China, what are you targeting in terms of growth there? What's the plan? Are you perhaps looking at expansion, hiring? What's the plan for China?
It's one step at a time is the plan for China. Let's see what materializes over the next few months. I mean, clearly we've been very focused on making sure we have coverage and footprint in China that reflects the reality that despite the many challenges, China remains a vital part of the global economy. And in that context, if the stimulus measures do appear and they are of the strength and force that will make a difference, we need to be ready for that. And I will say at this point in time, our clients are positioning on the basis of something is going to happen. And the volatility means we need to be ready in whatever direction that goes. So for us, making sure we have the right resource in China remains a priority. I'm very comfortable that we have that level of resource. And we have been long-term committed to China. That's not changing. So that's how we look at China.
Kevin, it remains a crisis of confidence. How much confidence has returned, and what else does China need to do to make sure that confidence returns for good?
Well, there's been a number of actions taken, mostly on the monetary side. In other words, you've seen the reserve ratios moved, you've seen some activity there that promotes on the rate side. People are looking for the fiscal stimulus. They're looking to understand how big will that stimulus be. Can domestic consumption be revived in a way that offsets some of the challenges, perhaps, to the export model? One stat, if you look at where growth has come from in China in the last 12 months, 60% or above has actually come from the export-led growth. Therefore, what had previously been a place where domestic consumption accounted for 60% or 70% of the growth, it's flipped. And that export model is clearly under pressure in a world of tariffs and in a world where some of the end-user markets are perhaps not going to be able to absorb the amount of capacity that China's export model leads towards. And that's why domestic consumption and looking to see that domestic consumption recover is such an important part of conveying the confidence that would allow people to see China's domestic economy revive in a way that would make a difference.
The Chinese economy has really seen so many false starts in some ways. It's been a really volatile year. I'm wondering, where do you see the fastest growth in your business segments? I know you talked about M&A and investment banking. What about private equity or wealth business? Which business and which regions are you seeing the fastest growth?
We continue to see our wealth business continues to develop very nicely across the whole of the Asia Pacific, and our wealth business is a very important part of what we have at Goldman Sachs. So you're right, we do see growth opportunity there. I would tell you in our trading businesses, in an environment where you have high levels of volatility, of course, those businesses also tend to be quite important, quite a lot to trade, and so we're certainly seeing our equities capital markets business still doing very nicely. And there has been a revival in some of the elements of our investment banking business, as I mentioned already. It's not a revival where you would say it's structural and lasting, but there certainly seems to be a window where people can access the equity markets, and that's why we're seeing quite a bit of activity there. And you've seen that in a flurry of A to H share conversions too. And I think that's an area where we're seeing growth, and I expect that will continue, at least for some time.
What about in India? Because India was emerging as a sort of bright spot last year, and especially gaining more importance given the concerns mounting around China. Do you also see a revival there in terms of investment banking, deal-making activities?
India remains a growth spot. I mean, it was a very hot capital market last year for the reasons you gave. We saw a number of IPOs. We saw a lot of activity pick up in India. I actually expect India will remain a hot spot. It may be the case that we see something less warm, it could be a little less boiling point than it was, but we will continue to see activity growth in India. Of that I'm quite comfortable. And I think that activity growth will be on the equity market side, it will certainly be in our investment banking businesses, and so I'm not of the view that India's hit a wall, it's hit a speed bump, and there's a big difference between the two. The structural growth factors, the digitization of the economy, the increasing pools of capital from the financialization of the marketplace, the extent to which the governance of India has been improving, and yes, geopolitics all play to India's favour. Those factors remain, and I think over time that's why we still see India as a growth opportunity.
Kevin, of late, we've been talking about that rotation from India to China. What are you seeing at Goldman, and what trend do you see for the rest of 2025?
Well, I think there has been a rotation. I think at this point in time, a lot of money is sitting on the sidelines with regard to China. That money to move needs to get more confidence, and therefore it's going to be, I think, after the twin sessions before you see anything fundamental by way of rebalancing or the movement of flows optimizing. Certainly for the international investor, I think it's worth noting for the domestic retail investor, China looks quite different, and we continue to see opportunities there. I think with regard to India, in my mind, it's less a rotation from China to India. Quite frankly, the big issue at the moment, of course, is the strength of the US markets and the strength of the US economy. It's something that's certainly come up here at this conference. So it's more money sits, pauses, looks at the US, and really only starts to look at Asia once we see some of these factors come together. And that's why I think actually in India, there's been a bit of a retreat in terms of some of that foreign investment level. That's not what's been powering the Indian markets. And in China, the money is still waiting to gain more confidence around the momentum in China. And that's going to take time to build.
So I think we've been seeing a lot of, especially for private equity fundraising, for example, China used to be at the center of that, but we sort of see that center of gravity shifting maybe towards Japan, Korea. Where do you see that moving this year, and how long does it take to really recover in Greater China?
And I would include India in that shifting point.
Yeah.
It's certainly the case that there's a lot of money being raised for deployment in India. I think it's also true, as you say, in other parts of the region. Japan is certainly a very attractive destination for a lot of private capital at this point in time. And somewhere between Japan and China, that's the bulk of it. But you're right not to ignore other geographies. Instead, we could also talk about Australia. We've seen quite an active marketplace in Australia this year, and we expect that to continue. So there's plenty of places where private equity, private capital is going to deploy across Asia. I think the hesitancy in China is partially because it's harder to get money out of China than it is to put it in. And so people are a little cautious around their exit strategies for China. They'd rather see the investments they've already made pay off in the form of returns. And so that's put pressure on investment levels into China. But with regard to India, Japan, and other parts of the region, including Australia, we're seeing quite a lot of activity and growth.
So what is the biggest challenge, you think, for markets in this part of the world in 2025?
Well, Asia's not for the faint-hearted. And I think anyone who's responsible for a business in this part of the world knows that. The uncertainties that dominate in Asia this year will include the known unknown of tariffs, what actually materializes, because that has a direct impact on economic growth and the performance of so many companies across the region. And certainly for an investor, that's the big one. The overall development of the US-China relationship, that will really matter. People are paying close attention to how that's going to evolve beyond the tariff point. And yes, they're going to keep an eye on just seeing, is the speed bump in India a speed bump and it returns to growth over the course of the next 12 months? And a reminder, there's other parts of this region too. That's the great thing about Asia. Pretty broad, pretty diverse. It doesn't all move in uniform. Let's not forget Japan. While the rest of the world is perhaps easing, Japan will be tightening. So you're going to see opposite effects. That creates opportunity too. So it's a complicated marketplace in Asia. That's why myself and many others have been here for quite some time, because navigating that is where the opportunity lies.
All right, thank you very much. That was Kevin Sneader, Head of Asia Pacific ex-Japan at Goldman Sachs. Thank you so much for your insights.
Much appreciated.
And our very own Min Min Low from the Goldman Sachs Global Macro Conference in Hong Kong. Thank you so much for that. Still to come, HCL Technologies CEO C Vijayakumar will be joining us with his insights on where the Indian IT is heading as Trump prepares to take office once again. Keep it here with us. This is Bloomberg. Welcome back. India's been trading for about a minute now. It is in positive territory. Sensex up by about 0.5%. In terms of the Indian rupee, 86.49, currently higher than the USD by about 0.1%. It is a dollar weaker story, not a higher Indian rupee story right there. Of course, the Indian rupee remains hovering at record lows. Now, speaking of India, Indian IT companies expected to gain from the weakening rupee and potential U.S. tax cuts under President Trump. However, the America First approach could also discourage outsourcing deals. For more on this, we're joined by C Vijayakumar, the MD and CEO of HCLTECH, which is India's third largest IT firm. HCL managed to meet profit expectations for the last quarter, but missed analyst revenue estimates. Good to have you with us. CVK, good to have you with us. I'm just wondering how you're assessing prospects for 2025.
Yeah, thank you for having me on the show. Great to see you. Happy New Year. As I spoke yesterday, we're seeing the demand environment improve from what we saw at the end of September to what we're seeing at the end of December across most verticals. We think generative AI is triggering a new set of spending on the IT side, which is really driven around application modernization, data, and really driving more efficiency and innovation, leveraging generative AI. So we see that to be a positive momentum at this point in time. And that's also reflected in our ACV wins that we've had during the last quarter.
Give us a sense of the kind of spending that companies are likely to make on Gen AI, and how will that translate to in terms of numbers in the quarters ahead?
Yeah, I think, see, the spending on generative AI would normally be very small ticket size deals. But I think what is relevant is all the opportunities that we are pursuing will have a component of generative AI infused into the overall solution, and that's really helping to drive a faster modernization or drive more innovation and efficiency in different value streams. So it's really an influencing factor rather than generative AI itself contributing to big revenue.
But in terms of the impact on your margins, what can be expected? We talk about digital transformation, we talk about AI offerings. What does that mean for your margins?
I think this will also help us move from some of the work that we do on a time and material basis to more outcome-based or managed services or fixed price kind of engagement constructs. And that will help us to deliver things more efficiently. And that could create some positive impact to our margins. However, it is a very large book of business, and there are multiple business elements which go into it. So we are largely 18 to 19% is our operating income guidance, and we are generally comfortable in that range at this time.
Of course, Indian tech companies like yourself operate globally, including in the US. With the Trump administration, is that good or bad news for Indian tech?
I think there is going to be a little bit more pro-business environment. So I think it's going to help the business sentiments and as a result of that, a little more spending momentum. I think it will be positive, but the broader global landscape could change due to various other elements which are not directly related to IT. And that could have an impact on how the clients look at their spending and what are their priorities. So at this point, it's really a wait and watch. We really do not have a good grip of what would be the type of changes and the impact it will have on our clients' spending, and then the impact on us for that.
One key focus is actually visas, the controversial H-1B visa. Of course, it's split down the middle. There's been pushback on these visas. How are you looking at it? Will it be easier, more difficult for HCL?
Interestingly, we are very less dependent on H-1B visas. We have, over the last many years, we've built capabilities to hire local talent in the geographies that we operate. Our dependence on H-1B is fairly low. And I think that's a good thing. And even if there is some changes in the policies, I think it will not have a major impact in our business model.
You seem to be pretty upbeat when it comes to prospects under the Trump administration for the sector and for your business. What do you see as the biggest risk, though?
I think what is going to happen to the broader business landscape, the tariffs, inflation, all of that, and how does that reflect in the client spending priorities? That's really the area to really watch out for. And I'm sure it'll be clearer in the coming weeks and months.
And when it comes to countering the lack of clarity in terms of where the dollar is headed and where the rupee is headed, it is hovering close to record lows right now. How are you assessing the impact on your business?
Yeah, I think strengthening dollar, weakening rupee is good because some of our costs are in rupees. But our business is quite diversified. We bill a lot of clients in different geographies, while US is the predominant currency in which we get our revenues. A lot of revenue comes from Europe, and even the clients who are US headquartered, we do work for them in Europe. So I think overall the pros and cons seems to be balancing with a little bit of positive benefit due to strengthening dollar.
CVK, talk to us about your growth markets. Would that necessarily be the US for 2025, given the weakness in the European market right now?
No, I think we expect to see a broad-based growth. And the definition of our growth markets is Asia, Japan, Middle East. These are the countries, ANZ, these are the countries which come into our growth market classification. And we are continuing to see good momentum. We did win a few deals in Japan, in Singapore, in different segments, in doing embedded design, SoC design for some of the semiconductor firms, also leveraging some of our IP in the airline industry. These are some of the wins that we've had in this geography in the recent past. So we see a good growth momentum in the growth markets. As per our definition, growth markets, as I said, is APAC and Japan and Middle East.
So will you be hiring for these markets? And will these be highly specialized roles?
Yes, we hire both. We hire entry-level talent and train them for specialized roles. And we also hire experienced talent for a lot of our requirements in different parts of the world. Hiring is normally in line with our growth expectations across different geographies and different type of services and solutions we offer. Yes, of course, we have hiring plans for these geographies, but I wouldn't be able to quantify anything specific at this time.
Maybe next time then. CVK, thank you. C Vijayakumar, MD and CEO at HCLTECH. Now, before we go, here's a look at tomorrow's program. Goldman Sachs International Advisors Chair Jose Manuel Barroso will be joining us live at the bank's Global Macro Conference in Hong Kong, and we'll get exclusive insights on the hospitality industry from the Radisson Hotel Group. That's it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.